rich time for both of us anyways. So let me get a recording kind of going. The rain stopped, which is nice. Screen share first.
What was I'm curious though, what was your motivation?
Yeah, so
how did you stumble across this? And
we actually were going to some real estate events, and specifically events where people were either investors or operators of like multifamily apartment buildings and things like that. And there were some guest speakers that got up and talked about, you know, you can use your retirement funds that you're saving up in other ways. You don't have to just stick to the stock market. And so they started explaining some of those details. I'm like, oh, that's really interesting. And a lot of the folks in real estate are always looking for private investors because you know, big real estate deals are all securing funds from either, you know, big fund companies or individual private investors or family offices and things. That's where they're sourcing their money to fund those deals, or at least portions of their capital stack. And so I thought, well, I don't trust my financial advisor, quite honestly, to give me all the best guidance because they're very motivated by their commissions, right? Or by whatever percentage of the funds they take. Even if they call themselves a fiduciary, everybody has a little bit of bias, right? In one way, shape, or form. And I thought, well, I've loved real estate. We've been doing real estate things prior to now, and I just thought, well, why not take it to the next level and find a way to fund the retirement more with real property and lending, more than just, you know, sticking in the stock market, which I have the least amount of control over. So that's what got me into it for sure. What? Oh my! You want me to hit the? I'm gonna start hitting record here in a second. My husband's
this is
like,
great stuff.
I know. Okay, fine. So he's like, you need to hit the record button. I don't even know where. Let me get this going.
The Zoom meeting happens in the middle of the woods. No one's around to hear it.
Okay, thank you. Pause, share, summary, stop. Where's my darn recording little icon thing? Is that it right there?
You are recording right now.
Oh, good. Then you can take.
Well, no, it says stop share. Hold on.
I don't know what's going on. I didn't even know it was recording because I stopped recording earlier.
Yeah, it does show on mine that you're recording.
Oh, okay. Well, I did not know that. I'll now announce it that I have been recording this whole time and I had no idea. And Josh is gonna do some editing of this and put some intros and all that fun stuff into it. But yeah, so this is really about my journey in investing with the self-directed retirement accounts. I'll start with the disclaimer because I have to do this for everybody, right? Like, first of all, I don't receive any compensation, any sort of guidance or recommendations or company names I might mention. That's just, you know, my own ideas, right? My own journey and exploration. They don't pay me anything for saying any of that. And because I'm not an advisor, I don't have a broker's license, you know, I don't have that attorney background or be an IRS agent. You know, there are a lot of rules around these things, so I encourage everybody to learn those things and consult with those individuals on any sort of impact because this can be very positive, but of course there's always somebody who has made certain choices and found themselves in trouble, and we wouldn't want that. So there's good ways to do it and ways to avoid it. So back to your question about, hey, you know, how did you even stumble across this? You know, going to those real estate events, it started to make me think. They were questioning some things. Hey, well, what kind of returns are you getting? I was like, I don't know, right? And, well, how do you know what you're paying in fees? I don't know, right? Like, it was just money came out of my paycheck. It went into Fidelity, and which is the largest holder of everybody's 401ks. It went into Fidelity, and my financial planner told me a specific allocation. And so, you know, it kind of just would always get split up into that allocation, you know, 20% in this bucket, 15 in that. And of course, we're always, at least most of 401ks, you're fairly limited in your choices, right? You get what your employer offers you, and it's, you know, a certain set of funds. I did figure out when I was working at Citrix that there was a sort of way to shift a percentage of the funds into the stock market more broadly. And so I was able to do that. I'll have to go back and find out exactly how I went to do that, because somebody told me about it, and then I was able to shift, I feel like 60-70% of the money I had saved up into more choices. So that was helpful. But what I did not too long ago is first of all, since I stopped working at Citrix in 2023, at that point's when I stopped actually contributing to the account itself. So I took a snapshot of my adult lifetime of savings. You can download in Fidelity, or I'm sure in Vanguard or whomever you've got accounts with, you can download your full transaction history. So you can see what you contributed, what your employer contributed stuff. So I just took the numbers, I plugged it into a calculator online, said, hey, what's my average annual rate of return? And it came out to be about 7.2%, right? So if you figure you're starting with a baseline number, what in my case, roughly 20 years ago, each year that number was growing on average 7.2%. That is within the average range of what the market, what all the, the Fidelities and Vanguards of the world say the projected rate of return is. For people putting it into their 401ks, their average rate is between 5 and 8%. So I'm a little more closer to the higher side, which is good. But in the back of my mind, I'm like, could I do better? Like if you've ever listened to kind of an older version of Dave Ramsey, who does a lot of financial coaching and teaching and so forth, he advises people, well, find something that gets a 12% return every year. Like, oh, okay, well, I'm only getting 7%. Well, that sounds like I'm behind the ball. And then only less than 2% of people have achieved over $1 million in their 401k. Now that is in part coming from you have a maximum amount you can contribute every year. My husband seems to be taking photos of me behind the scenes here.
Yeah.
It's not lightning. So I was like, okay, well, wait a minute. Very few people have achieved over $1 million. You need a lot more than $1 million these days to retire on. Like, I've got some time still. There must be a better way. Like, the whole point was like, hey, is there a better way? And I could never figure out the fees that were coming out of the account. I couldn't tell you. Maybe I paid very little. Maybe I paid a lot. I don't know. I still don't know to this day. I couldn't tell you. I feel like they hide those things. So I thought, okay, what else can I do with this? And getting connected into some real estate groups had me very curious. So the thing about a self-directed account is you're handling still all of the decisions about what you're buying and selling, just like when you're logging into an account and picking your funds and stock and whatnot. If there's 401k, you're still deciding what you're putting the money into, but you've got to have a qualified custodian or trustee named as the administrator of those funds. So without that, it's not a retirement account as the IRS defines it. So most people, have changed jobs a couple of times over their career. So you take your 401k, you can roll it over into the new 401k, or you could roll it over into some type of IRA. Self-directed money only works for your previous investments, not your current employer, right? So like if you're contributing to your current employer's 401k, you can't just take that and generally, I haven't found a way, at least. If somebody knows, great, they can tell us, but you can't just like shift that around and put that in real estate. But because most people change jobs several times over in their career, they usually have a history there where they can take that money, roll it over into a location with a custodian, either as a traditional IRA, Roth. I was able to do it with my HSA. And if you have a business, you can actually put it into your own business's 401k if you have a business where it's no employees. Like Josh and I, my husband and I, we have a business, and so the two of us are owners in the business. We've been able to start our own 401k inside of that business and roll some of those funds over into that. The thing is, it still has the same tax considerations and the same rules around withdrawal as any other any other retirement account status, right? You're putting in pre-tax money, so you want to do things that don't turn that money into a taxable event. And then there are some additional rules on the self-directed, which we'll touch on. But the cool thing is you can invest all sorts of stuff. That's what I love about it. Like some people go a little crazy. I think I feel like I heard somebody, oh yeah, it's the bottom one, livestock. They bought cows. I don't know why that makes sense for them, but if they figured out it makes financial sense, you can buy all kinds of real property, real estate, you can do land, you can actually loan money to other people, either through, you're going to want to do it where it's secured by some sort of collateral or asset, unless you really think you're going to loan, you can trust that person, you loan them some money and it's not backed by anything. You don't really have good recourse to go after that money should they default. You do promissory notes, tax liens. If you're doing precious metals, there's some more specific rules about it. Like, I'm pretty sure you can't just like have a pile of gold sitting in the closet at your house. There's a certain set of rules around storage for that type of thing. But people can do crypto, oil and gas, water, mineral rights. That's kind of an interesting one. Again, some areas I'm just not an expert at. I don't touch, but I do find it interesting that you could put your money into those things. I just happen to have a passion for real estate. And you can even invest in other people's businesses. There's some rules very specific to like, I think it's called disqualified individuals would be the way to say it. So like, you can't go buy a house that your family members live in, right? Or that you live in yourself. You can't do things. There's a group of people that you cannot do business activities with as it relates to using the retirement funds, because that comes across as something that would be benefiting you now. And the whole idea is this is a retirement age type of benefit. So the key is to pick a good custodian, because they're the ones that can help you navigate through this and not get yourself into hot water. The benefits, as I see them, is you get greater control over your investment choices, right? You actually can, there can be arguments to be made. One thing to say, well, I'm going to pick a couple of stocks. I don't know the CEO. I don't know any of the C-level people working there. I'm making my decisions off of, documentation about the direction of the company, where they're going, what they're doing, what the pundits say is going to happen with that stock and so forth. But I have no control at all about what could happen. At least in this case, the control I have is my evaluation of the individuals or smaller organizations, or maybe in some cases a few bigger organizations that I want to place these funds with, right? You could place your funds in a fairly large REIT, something like that, which is another way of investing money. Or you can turn around and literally go buy a house or an apartment complex, or put the money with a operator who owns 4,000 doors of apartment buildings type of thing. You get choices. So I like the fact that you got greater choice. You can vet the people that you're investing the money with, because even though you're investing it in the opportunity and the asset, a lot of times you're also investing in people, right? And you want to be able to vet those people. I like the fact of owning it, a physical asset. And I like the fact that I can have a good grasp of what it costs, right? The fees are a little more upfront, transparent. Sometimes it's unpredictable. I mean, if you decided to buy a really, really rundown property, you're going to have unpredictable costs associated with that. And so maybe that part is a little less predictable, but there's a lot of times where you can have good predictability. And just like any sort of investment, the higher the risk that you're going to take, the higher the reward potential, but also the higher risk of a loss. Okay, so I'm going to hit on maybe 2 more points, and then I'd love to kind of, ask you a couple of questions and get your thoughts and your questions as well. So, back to the point of risk, there's never anything without risk. There are some very clear rules, right? You can't touch the money. So as an example, you buy a property and the tenant needs to pay you rent, right? You're not collecting cash from that tenant. So you can have a third party collect cash, but you can't, right? You can't really touch that money. You don't want that money going into your personal bank account. You don't want to commingle anything. It's a very restricted account. It has to be protected. And the best thing to do is have third parties that are managing those things, which you plan that into your budget of what it costs when you're looking at your overall returns, in order to make sure that you're not breaking any of the rules that the IRS has set out for us. So you couldn't take rent money and put it directly into your personal account. You can't take the real estate that you purchased with the funds and turn around and get a personal loan against that real estate. It cannot benefit you right now personally. You're really like a steward and I don't think it's legally called a trustee, but in some cases it might be. Like you're overseeing it for it to be successful in the long run, and you get the benefit of it when you hit the retirement age and not prior. You don't want to allow disqualified people. So that's yourself, spouses, children, any sort of fiduciary administrators that are involved, and some family members. So those are things to watch out for, because then what happens is that's looked as a distribution, and you will be taxed according to that current moment. If you're below 59.5, there's a 10% penalty on top of what your ordinary taxes would be. Because when the money went in, it went in without being taxed. So while it's there, it needs to continue to do things that allow it to grow, either tax-free if it's like a Roth, or tax-deferred if it's more traditional. Okay, so here's what I did. And we'll start to go through this layers. But, I guess maybe before even starting into that, I think before you mentioned this isn't something that you'd heard about before. Do you have an interest in real estate at all, or you have a background in any real estate investing?
An interest.
Okay.
Definitely an interest.
Okay. Yeah. And you're up in New Jersey, and so I say kind of the best thing is either to look around locally, or if you're going to invest in something that's further away, you really have to vet the people who are going to really, that you're hiring to be responsible for managing on your behalf, right? The thing about this kind of investing is it's not like you're going online and clicking a trade and things end up in your account. There's more paperwork involved. There's more steps. There's more interaction with what you're purchasing than just buying a stock, throwing it into the account, occasionally checking its value, and then selling it at some point to buy something else. So in our case, my family, I don't even like what I did. So I'm gonna I'd be very honest about what we did and what's working and what's not working. I didn't do my research. Part of the appeal was the kind of gains, the kind of returns that we could get out of this. But I didn't vet the company that is the custodian enough. I heard one company, I said, that sounds great, I'll sign up with you, which is different than actually having shopped around and said, which custodian is best for me today and down the road. So I paid way too much money, right? First of all, you don't have to pay $6,000 to start this. I happened to pay $6,000 to start this up. Horrible decision, horrible. Because actually you can go find a custodian with a flat fee for, $500 to $1,000, right? That's a big difference between the $6,000. Now, granted, I also have a lot of accounts. I probably started out with too many accounts. I really didn't need all of these things. I should have started out doing one and then migrating to the next one and the next one. And I started early. I wasn't even gone from Citrix yet. I was, we started these. I could have waited. Because I moved a little bit of money into these accounts, I didn't really deploy it very quickly. So I feel like it's the kind of thing that you want to have a plan for right when you're getting started, versus just I did a bit of a dive in and learn it as I go, which is why now I want to teach everybody so that you don't do what I do. Save yourself a bunch of headaches and stress. I also ended up picking a custodian that had high recurring fees in terms of what it costs every year, because not only were they charging like a service fee to provide me a higher level of service, they were also charging a percentage of the asset value. So, in my case, I had almost maximized my contributions for almost 20 years straight. And if you work your way backwards in some of the calculations, I'm getting close to the $1 million mark, actually. And so it wasn't, a percentage of the asset value against a number like that. That's a lot to pay. And what am I getting in return for that? I'm going forward, I'm going to a flat fee. And there's some other things I can do to keep my fee structures down, which I'll be speaking about in a minute. But this is just setting up the stage. This is what we set up. My husband had a Roth. Financial advisor told us to do that. I had a Roth. Financial advisor told us to do that. Moved those over to the self-directed. We have a business, so we set up this 401k plan against the business, and they set up 2 accounts. Much like the traditional IRA and the Roth IRA, there's a tax-deferred account, and there's this tax-free account that behaves like a Roth. Then we set up something for the kids, each of the kids. Then I took the HSA as well and rolled that over, and then I had also a traditional IRA and rolled that over. And that was, again, at the time, years ago, financial advisors said, hey, now that you've maxed out your 401k, use after-tax money, put it into a traditional IRA, because at the time we were making too much income to qualify for Roths. And some of the Roths happened because there's a backdoor way for Roths and all that. Anyways, it was a very large set of accounts. Most of the money, like 97% of it, was really money that was going to be moved into the traditional IRA. And then ultimately I moved it into the 401k for the business. And so this is just too much, right? So my net of that advice would be whatever account has the largest. Like if your husband's account, he might have an account, you're going to have an account, whichever one is the largest. If you're ready, when you've kind of set up yourself, just start with that one, right? Worry about the smaller ones down the road. Start with just the biggest one. I decided to do this with the funds, and this is kind of where it gets fun to talk about it, right? The meat of it. I ended up buying a house, and then I ended up loaning the rest of the money out for shorter durations. The thing about buying real property in your retirement account is you won't get depreciation benefit. What you get is the rental income if you're buying a property that has rental income, and you're getting the appreciation of the property. Those are the benefits that you're getting. So it's predictable, right? Generally predictable, because you're like, okay, I buy a property and that property produces this amount of cash flow every month. So I can calculate, hey, if I put $100,000 into buying the property and I'm getting $1,000 a month, that's $12,000 a year against a $100,000 investment, 12%. Woohoo! That'd be great. Not everything, of course, will turn out that way. But yeah, I bought a house from a company that, I guess I should back up. I went to a private money investors event in Raleigh. I paid a couple $100 to go. It was very cool. Lots of like-minded people who were there to borrow, people who were there, what's the opposite? Selling stuff, right? There was a lot of different folks there representing a lot of different needs. So it was a cool networking space to really understand what people are looking to invest in, who's looking for money, who's got things to sell. So I ultimately heard a guy and his business partner on stage. They operate out of Macon, Georgia. They do this a lot. They buy properties, fix them up, sell them to investors, and property manage it for them. So I never went to the property. Never been there, right? So I bought a house that I've never been to. It came down to trust. Trust of people is really, really key here, right? I interviewed him. We went through the numbers. I will be doing another session interacting with him and putting his name out there a little bit more, because I've been very impressed and had a very good experience in working with them. Everything he said he was going to do, he did. It wasn't without some complication or problem, but when it came up, he was quick to solve it. We had a plan, everything. It wasn't like a costly sort of problem, but some decisions to be made. He was on top of it, right? The property was inspected. There were some issues. He said, I will fix those before we close, right? It was really a super easy process. So it's turnkey managed property out of Macon, Georgia. It's like a 3-bedroom, 2-bath house. It's got $900 a month in cash flow because I paid cash. So let me back up again. You can, under certain circumstances, get a loan and use a portion of your self-directed funds as the down payment. However, there are a lot of rules around that, and very specifically, it's got to be a non-recourse loan. That means that if you default, the bank will not be going after your account. They just seize the property. They see the value in the property, and the loan is secured by the value of the property. I have not done that type of loan yet. I've chosen to just buy things from the account with the cash that's in the account and not do any sort of loans. And I will probably get there sooner than later, and I'll record something about how to do that part. Usually requires a significant down payment, and I cannot remember if you can do that with both the 401k account that I have from the business and the IRA, or just one of those. So there is certain scenarios where you can borrow, but you have to be very careful about that, and you have to be very careful about doing things that are active, because those can trigger other tax consequences that you weren't intending. Which is why, like, you don't want to have you're not the one doing a paintbrush, walking in and even like designing and decorating and doing work inside of these properties. It is best to buy a property that is turnkey, managed by property management, and that way the checks just come in, versus you having to do a lot of work being actively involved in what's going on in the property on a regular basis. So the tenants never call me, right? They call the property management company. AC went out. Yes, there's a $500 repair. Okay, there's a reserve fund set aside for maintenance. So far, they've never had to call me and ask me to provide more funds than what I used to buy the property. Sometimes I might get a little less in cash flow that month if they've got to take it out of the cash flow for a repair. Okay, before I go into the rest of it, interesting, right? What's going through your mind? Questions?
Well, the last one here is $7,000 car loan, 12% per year. Like, how do you? I'm trying to understand how that takes place. That transaction takes place.
Sure. So every single one of these transactions has paperwork behind it, right? And that's made up of. Sometimes it's just because if it's an outright purchase, like a property, that's going to be, a deed and standard property purchase types of documentation. When it comes to being the lender, so this is what I started thinking about. Like, in the end, I know I want to go buy an apartment building, but I wasn't ready. I had a big chunk of money, but I wasn't ready to really go buy that apartment building and figure all those things out. There's a lot of things going on in our life that I just wouldn't have had the time for. So I said, well, this money needs to be working for me. Why don't I go lend it out to different people who are doing things and, get a return from that? So if I take the bottom up approach from this list, there was somebody in our life that was in a really desperate situation for a car. She was in quite the bind, and she was going to go to one of those buy here, pay here types of places, and they, gouge people in terms of the percentage. I'm like, well, I can offer you a better set of terms. The risk is, of course, how reliable is she? Right now that one's risky because I'm not sure she's going to pay me back. I'll be quite honest on it. But I liked the idea of it, at least. What it was a promissory note that was drafted up. I ultimately used Rocket Lawyer to draft up a promissory note because that was a really inexpensive way. I could have spent a couple $100 extra for a local attorney that I know to have drafted that. I've done enough of these to recognize, like, I know what needs to be in them, so I was okay using something a little more templatized. So wrote up a promissory note, put in all of the details, described that this is like a lien, right? Or like on the car itself, right? The VIN number for the car is being put up as the collateral. So it's still a loan against a piece of property. And we just wrote out the loan terms in the promissory note. And then you do something on the title, the car title itself, because she doesn't get to keep the car title, right? Because you're in the first lien position, so you got to file some paperwork when it comes to the car title. And then I just sent this. We signed documents. She signed them, sent them over to my custodian, and my custodian just sent her the funds so that she'd have the funds to actually close on the car purchase. Wasn't particularly more complicated than that. Other, there's a couple of steps. So you get into things like, well, I don't have a checkbook controlled account right now. That is one of my recommendations to put what they recommend, and I would spend the extra money to do it, is you get an LLC and you have an operating agreement that describes it's on a retirement account that is owning this LLC, and it has rules around it so that you don't get in trouble with the IRS. But then you could take that to a bank. They will set up an actual bank account. The custodian will move the money into a bank account, and then you can do things like you would normally do with a checking account and with being able to sign for transactions, right? So if I had done this with an LLC, I would basically be saying, Micah's retirement account LLC is loaning $7,000 to, lady single mom, and that would be in the documentation. And then I would be going to, write her a check for that amount. And then she starts making payments, and she would send those payments written into my LLC's name, and I deposit that into the bank account. And then the bank account is just used to continue to make investments in. That to me is the most efficient way, because right now I actually have to send paperwork to the custodian every time, right? Every single time I have to fill out a form that says, please direct my money for investment to here, or please pay this bill, or please do this, or please do that. And I would prefer the checkbook control. So the checkbook control is worth extra, probably $1,000 to get started with that. But that's, and then you'll pay a couple $100 a year to maintain the LLC. So it isn't without a cost, but it's worth the convenience. Especially like if you've got some, like it happens, right? The more funds you've got available, the chances are you'll have something that you might be able to act on very, very quickly, right? These deals can come up very, very quickly, and the person who can get the funds into the right place very quickly tends to win the deal. And so having that checkbook control is truly, I think, the best way to be able to get into a deal very, very quickly, and not have people waiting for funds to clear, paperwork to be signed. Because I lost a deal. It was a great deal. It was like $48,000 manufactured home on a great property. It probably would have been 2x what I paid for it, right? If I had been able to close on it quickly and do the things that needed to be done. But because I had to send stuff off to my custodian and wait for them, which is 3 to 5 day turnaround time, the seller went with somebody else. So that is the risk.
How do you go about shopping around your custodian?
Yeah, so I've actually started some of that process that I'll start to share with everybody. But I honestly first started with who's out there recommending a ranked list, and I think it's Investopedia. They did a top 6 ranked list based on this certain criteria, right? The dollar value that they hold, their customer service, their portal, self-service friendliness, technology forward sort of stuff. So at the end of the day, for me, it is about a couple of things. It is about the customer service. Do they answer their phone when you call? Because there's actually some of them out there that they have a bad reputation for that. They don't answer the phone. You don't get a live person. You're not getting to your answers quickly. What their fee structure is their fee structure reasonable, right? There's always going to be fees. Is it reasonable? And like, for example, if they charge you $75 for a wire transfer, well, there's a lot of banks out there. Yeah, I have one bank that charges me $55 for a wire transfer, but I have other banks out there that are $20 or $30 for wire transfer. So I look at those kinds of things and go, well, wait a minute, are they gouging me on certain types of fees? Are they just charging me for things that's like I shouldn't really be charged for that process, or they're overcharging for something like wire transfers? And then the other thing is just like the technology forwardness of them, right? Do they have a self-service portal? Do they do digital signatures? instead of sending handwritten papers over. And again, my current custodian, I'm not going to name them and throw them under the bus, but I have to handwrite forms. And I would rather, be able to fill out the form, start a DocuSign document, send stuff to them so that they can sign it. I feel like they should be more technology forward, and they're not. So there are those out there that are. So you want to look for the technology forward. And how present are they on an ongoing basis with their education, right? Do they have thought leaders, more than one, out there constantly explaining and giving new ideas? Are they on top of the IRS rules and saying, hey, the IRS rules have changed, here's what you need to know now? Like, they should have some figureheads out there really talking about how to maximize success with this process. So those are the criteria for me. I have a short list of 4, and I'll name drop those in a couple of minutes, but those are the ones that I'm personally going forward with. I want as much control as possible, which also means then I want somebody who's going to handhold me through this checkbook control process. And my current custodian did not. They gave me a very lightweight form that says contact an attorney, do this little step, and then send the stuff back to us. It's more there's more steps to it than that, and I didn't feel like they were guiding me through the process. They were just throwing it over the wall and says, you can do this, go figure it out. And I don't want anybody to break any rules, but I do want the hand holding. So if they're not, as custodians, they can tell me, well, here's where we draw the line. However, please go, here's 3 or 4 choices who you can talk to that will really guide you through the process. I would still be okay with that versus just I don't know, go figure it out, come back when you have. So yeah. So I do plan to switch more and more to real property. I have some real property now with this house. And then I went ahead to go down the path of short-term lending, 1 to 2 years, some of them are less. I did put you can go find syndications, could be offices, industrial apartment buildings, multifamily. I come across a lot of those for syndications. That's essentially operators of either a portfolio or they're buying a very large, maybe not even large, sometimes a smaller apartment complex, and they're looking to raise some capital, and they have a private offering out there for usually accredited investors who can place money. So they usually have minimums, 50K or 100K minimums. And I happened to pick one that's a group out of Denver. I took $100,000 and I put it into their portfolio fund, and it's got a 5-year exit. So I'm not going to see that money back for like 5 years, but it pays they call it preferred return. It's kind of dividend-esque, but it's preferred return of coming out of the cash flow they're getting on those properties. They pay a preferred return every year. And then at the end, when they start selling off the properties or they sell off the fund, they do different things. Then I get the original equity I put in back, plus whatever gains they've documented in the material. So in that case, I'm expecting to double my money in 5 years on that particular whatever I put in. So yeah, I went through. I put in an investment with a land development deal. I went in and put money in with a guy who has a massive single family portfolio, and he was fighting with a bank that he had been working with a long time, and he just needed to get out of that, and so I kind of I end up being this temporary bridge for him, right? Buys him some time to figure out what he wants to do in terms of which bank he wants to shift those loans to, and then I've even done small amounts to house flippers and you got to be careful. I trust these folks enough. We're actually in the second lien position. But generally, first lien position is where you're, what you should be doing, and maybe unless you really trust them, second lien. But first lien position is where, if anything happens, you're first to get paid, or you're first to reclaim the property. Like, all of these are secured by property. If they don't pay, if they default on whatever the loan terms are, then I have a right to claim the property instead. But if you're in the second lien position, that means there's somebody before you that has that claim first. And so that can be a little bit tricky. But these are, house flippers. There's 6-month terms on the loans that, and we put in things like guaranteed interest for a period of time. That way, I actually could have a higher return if they operate in a faster manner. Okay, so a few more things. What I have learned in setting up these accounts is, as I've kind of already highlighted, start with the right custodian. That's key. If you're going to do this, spend the time picking out the custodian that you want to stick with. I just think that's so much cleaner. Having learned the hard way, I should have started with the right custodian. I also think that it really does take somewhere between $1,500 and $2,000 to get started, and around 30 days to get it all going. There will be an account fee to open up the account. There should be, if you're doing checkbook control, I've counted for that in the $1,500 to $2,000 for the checkbook control and establishing that. The cheapest I found for that is about $1,000. So that's kind of where I thought, well, $500 to $1,000 to establish an account, $1,000 to establish a checkbook control. That money can, if done right, come out of the retirement account itself. Like, it's not necessarily out of your personal pocket at this second. So that's a potential option. But it really did take 30 days to get the money from all the way from point A to point B. I happen to have a loan against the 401k, so I had to pay that off, and it had to clear. If you did, even if you took those 2 business days out, it took me a solid 30 days, because what happens is you're most likely, generally people don't have their money just sitting there not in an investment. So you have to sell out your positions in your accounts. So you got to cash those out, just like selling any stock or mutual funds or whatever. You got to wait for that to clear. That usually takes a couple of days to settle. Then, in my case, and Fidelity being the largest company out there doing this in terms of volume and size, they mail a check. I couldn't believe it. They mail a check to do the rollover. I haven't, maybe that's just normal course of business that everybody does, but they had to mail the check. They overnighted it to me with the custodian's name on it, and then I had to send it over to the custodian. So it was crazy. Like, Fidelity mailed it to me, I mailed it to the custodian. Like, the mail just, I don't care if you pay for extra money overnight, that's still 2 to 5 days of flow through that process. And then when the custodian got the check, it still needed to clear the account. So never was anybody, I asked, they're like, I couldn't just wire money. I couldn't just have the money quickly flow from one, it was a big chunk of money. Couldn't just go from one place to the next. So there was a lot of really antiquated, I feel, process involved, but that's, I guess, the banking systems. The money was on hold for a bunch of time, and then I still needed it to be in the right account on my side, so it took 5 more days. So in the end, it was 30 days. Could it be slightly less than 30 days for you? I'm wondering, with the right custodian and the right guidance, yes, but you're still waiting for the monies to clear the different spaces that they need to clear. So I think it takes some time. I love having that I have a business and I was able to put those funds into the solo 401k. There are some additional benefits around that, around being able to borrow the money back out, some higher contribution limits, but you could do without it if you don't have a business to start with to do that, and over time make that adjustment. I mentioned before, and I'm going to say over and over again, checkbook control is the best. That's what's needed, in my opinion, to have the greatest control and the lowest amount of fees. Because at that point, you can pick, a bank that's going to do essentially a business checking type of account, and pick the right bank there. Like, the funny thing for me is, Fidelity will do a cash management account. So if I've got the LLC established, I'm thinking I can actually go call Fidelity right back up, and the money will go full circle. It came out of Fidelity and it'll end up back in Fidelity in a different way. And you can do checkbook, you can do check writing and debit card and all that stuff from a Fidelity cash management account, and they have $0 wire transfer fees. So that's kind of where I'm heading. It does, this whole process though, is you do have to keep track of some things on your own, right? The custodian will store some things in the portal and whatnot, but it is the kind of thing that you have to stay on top of. The returns can be so much greater. Like I'm looking at one of the land development deal. You know, that could be 30-40% return on my investment in a year's time, right? That's a big difference than my 7% annualized, return. But it is the kind of thing that you got to, check in with the guy. Hey, how's it going? What's your plan? Can you give me an update? And you got to check on it, right? Because people who are communicating with you about what's going on with the money that you sent them could mean that there's something wrong, right? Yeah, they go silent on you. They ghost you.
Oh.
Okay, so kind of wrapping it up. The custodians, and I'll send out this presentation. I'm going to post this presentation. Investopedia listed the 6 best. For me, some of the ones on that list, they didn't meet my criteria. My short list is IRA Financial Group. I called them, had really good conversation with them. They even offered me a promotional price on my account sign up. So, I'm realizing you can actually ask for discounts and see what they might do for you. I think that that's possible. I really like Directed IRA. The guy has written a book. He's got a lot of YouTube videos out there. Their fee structure makes sense. It's flat fee. They help with the checkbook control. I want to do some complicated things, and they're the only ones I see out there educating people on whether you can do those complicated things or not. So I appreciate the thought leadership coming from them. Equity Trust is just a big known name. They're on that top 6 list. Alto IRA is also, I believe, on that top 6 list. So I want to compare and contrast those 4. I don't think there's not even anybody else, unless when I post this and I get a bunch of people saying you forgot so-and-so, and it's just repeated over and over again, and somebody's like, I'm a super fan, I love them. This is my short list, and this is what I'll do a little video about evaluating which one I conclude on. IRA Financial Group and Directed are my 2 top leaders right now, but we'll see. But what I want is, people who are going to explain things to me, answer my questions, be accessible, make sure that I, they have the capabilities or guide me through capabilities on checkbook control, flat fee, transparent fees, solid portal. That is my criteria. That is what I'm looking for. And so when I think about getting started, right, when you're ready, the first part is picking that custodian, paying the fees. You're going to roll over everything with the help of the custodian, set up the checkbook control, take the time to go through those rules, what you can and can't do. Think about then, well, how, I feel like this is a parallel part of the process, which is go start now meeting with, talking to brokers, other real estate investors, like learning what's out there and what you want to get into, because there's just so many choices, right? Back to point, if you want to go buy some livestock or invest in a farmer's business or some precious metals or oil and gas or buy some property, like so many choices. Narrow it down the criteria that you're really looking for. Get the funds actually into your LLC so you can start buying stuff. And then anything you're buying property-wise, make sure it's managed through a good third-party property management. So this guy, Mike, who does this out in Macon, Georgia, he does this with a lot of investors. So I'm going to record a session with him and make that available to everybody. And, certainly broker introductions to him. I don't make any money off of that, but my own money is, my retirement funds are in an investment with them, and I like what they're doing. And that's investing in a real asset. You own a house, you own a property there, and they're managing it with sending you then the cash flow coming from that. Oh my goodness, that was like a big dump, wasn't it? That was a good overview. What else comes to mind? What questions can I answer for you?
Nothing at the moment. It's a lot of content. Because this is I haven't really done any research on this. This is my first exposure, post what you posted,
Yeah.
To learn a little bit more. So it's a lot of a lot of information to just lots of different pieces to kind of delve into and explore a little bit more.
Yeah.
But yeah, this was a really good overview.
Excellent. Thank you. Yeah. So, I'm obviously I'm very passionate about this topic. One of many topics that I get to be passionate about. For me, down the road, I continue to want to find other investors who are doing things that I can invest in with this money. So I'm always looking to find out who's got really great projects. At some point, as well as I build out my skill set as an operator and in owning and buying multifamily, I'm certainly going to be out there seeking funds and seeking investors who would want to participate in those and be able to provide them with returns. So I'm both on the borrowing end and on the opportunity end. So yeah, that's kind of where I'm going with my stuff. So cool. Well, thank you so much for giving me the time, and looks like we made it in just about an hour, even with our technical difficulties. And for the video, if anybody else would like to schedule a one-on-one session with me, here's my good contact information, and I'd love to hear from people. And thank you, Natasha, for a good time. And give me a ring again when you want to chat more.
Sounds good. Thanks, Micah.
You're welcome. Bye.
Bye.
How'd I do?